It's not uncommon in equity markets for stocks to rally shortly after small investors exit, and Paytm may be turning out to be one such case. While retail investors have steadily trimmed their holdings in the fintech firm, mutual funds have quietly raised their exposure over the same period. What stands out is the consistent rise in mutual fund ownership over the past 2 years. Their stake has surged from 2.5% in June 2023 to nearly 14% by June 2025. In contrast, retail investors reduced their holding to 9.7%, down from a record high of 14.5% in March 2024. Paytm's IPO was one of the most disappointing debuts in Indian equity markets. The stock plunged over 27% on its first day of trading compared to the issue price of Rs 2,150. After listing, retail investors held a 3.5% stake, which climbed to 14.5% by March 2024, even as the stock tumbled 81% to 402.65 rupees during that period. Interestingly, since retail investors began paring their stake, the stock has rebounded sharply, delivering a remarkable return of 166%. High net worth individuals have also steadily increased their exposure, with their stake rising from 0.6% to 2.5% over the same 2-year period. Meanwhile, foreign portfolio investors trimmed their holdings by 17.2 percentage points, bringing their stake down to 54.9%. The shift in shareholding comes ahead of a strong earnings surprise. Paytm's parent N18V Communications reported a net profit of 123 crore rupees in Q1 FY26, led by solid performance in its core payments business. The results revived investor confidence, prompting several brokerages to revise their target prices upward. Revenue grew 28% year-on-year to 1,918 crore, the first top-line growth in 6 quarters, with financial services driving the performance, though marketing services continue to lag. Jefferies, which upgraded the stock to buy with a 12-month target price of 1,250 rupees, highlighted a 3% quarter-on-quarter increase in monthly transacting users to 74 million and a 6% sequential rise in gross merchandise value, which was also up 27% year-on-year. The brokerage noted Paytm's recent re-rating supported by improving fundamentals and potential inclusion in the MSCI index. Despite the rally, the stock still trades at around 30% discount to PB Fintech based on estimated FY27 EV adjusted EBITDA. Paytm's turnaround is noteworthy considering it had one of the worst debuts among large IPOs. The 18,300 crore rupee public issue, the third largest in India after Hyundai and LIC, saw a steep sell-off on day one. But with improving fundamentals and growing institutional interest, investor sentiment finally appears to be turning.
Well, thanks so much for tuning in to CNBC TV 18. Make sure you follow us and stay updated on all our social media platforms.